We now expect at the minimum another 50 basis points of rate cut in 2021, and I would argue that the risk is more cuts than less cuts. Here is a budget that was presented 3 weeks after news of the biggest shock that we are encountering in 2020, which is the coronavirus. This is going to have, or already is having, a significant impact in the region's growth and in global growth, at least in the first quarter. Chinese cities that have been closed down for already a week, in 10 days actually, February 9th, the first 9 days of February, represent about 80% of China's IP, and there is probably cause to believe that some of that might, in some of the cities, that restriction might even be extended. So I think we should brace ourselves for a 1Q global growth number that is, could be very, very, very surprisingly low. I'm not saying that there isn't going to be a recovery in the second quarter or in the third quarter and that we will not go back to where we were, but the major risk facing the world right now is an actual disinflationary, and on top of that another slowdown in growth. This could well prompt the Fed, and we already have that 25 basis points rate cut, the Fed to cut even more, and global disinflation to become even more aggressive. So my point is that, if you look at the global environment, and even in India, you just take away headline inflation, food inflation, and you're down to core, and core is at its lowest we've seen in many, many years. So my sense is that I know that, a headline number of 7.5% of inflation doesn't look, the optics are not right to do a rate cut. But, once that headline inflation rolls over, which is likely to roll over, I think the space for cutting rates is significant.
So overall, I think I would think due to all these three factors, inflation inching up, maybe a little bit more comfort on growth, and the role of other policies to complement, I think it seems a status quo would be more likely. They might change the stance from being accommodative to a neutral.
Really?
Because,
that'll shock the markets.
I'm not sure if it'll shock the markets, because generally I think rates have been going up, right? And rates have been going up in the swap markets because with inflation going up, and again some comfort on growth as well. So I think it just opens, it opens the possibility of, if just in case, if the uncertainty around inflation gets more magnified, it gives you a window where you can, operate the other way. I do think the bar for raising rates is very high at this point relative to another cut.
Governor Das is in a bind as well. Inflation is way too high for him to cut interest rates at this point in time. But he has made it very clear that he wants to support the market, support the government, support the fiscal spend to the extent possible. Last year, inflation was low. The external context was absolutely benign, and therefore India could effectively afford to print and spend, and that's what it's been doing for the last 2-3 years. Those degrees of freedom are coming down. Inflation is on the higher side at this point in time. External sector is still benign, but you never know. Too much of this print and spend extended for too long, and you are risking financial stability. I'd much rather we went into actual, structural reform to address the core issues than keep playing around with Excel spreadsheets and hoping to print and spend our way out of trouble.
No, fair point. Kaushik, one quick word on monetary policy. Would you also expect a continued pause?
We are in the midst of a credit market which is not functioning properly. There's no question of allowing interest rates to move up. But as I told you, the fiscal side of the story is such that it will have a natural tendency to push interest rates higher. And small savings interest rates will not come down because the government wants money. So the best that you can hope is RBI maintains the accommodative stance. I hope RBI doesn't change that to neutral, because that would kind of indicate that RBI is giving one possibility that at some point of time RBI can consider hiking rates. That could be damaging for the market. So at this point of time, you maintain accommodative monetary stance till you get to a point where you can consider whether you can cut interest rates or not, given the global growth could again slow down because of the virus in China. So we need to wait for that. At this point of time, wait and watch. I think from an RBI point of view, they'll get a lot of comfort that government has shown a 3.5% number for next year and wanting to bring it down to 3.1 in the next 2 years. So RBI probably will take that as a source of comfort and maintain the monetary policy stance as accommodative.